This video is sponsored by Morning Brew. Click the link in the description below to start getting your summary of the daily news today. The investment field isn't exactly known for being the good guys of the economy, but when it comes to industry villains, there's perhaps no character more despised than the hedge fund. Hedge funds are, after all, an instrument that, by their very nature, helps the rich get richer. And excessive risk taken from the area has been a driving force of many financial disasters in the past. Just recently, we saw how a single hedge fund, Archegos, caused billions of dollars in losses for the financial sector, while prompting a stock sell-off in certain areas. And much of the 2008 financial crisis was a result of risky bets from the area. There's also, of course, the whole GameStop fiasco, where funds excessively short-sold the company and almost drove it into the ground, with only investors online kind of prompting a reverse of that trend. But what exactly is a hedge fund? After all, at first glance, it doesn't appear much different than a mutual fund, something many of us are able to invest in that rarely ends up in the news for financial mischief. But hedge funds are quite different for a few key reasons. And while they are often only accessible to the elite, that might be for the best. We'll explain why that's the case and more on today's Plain Bagel. The term hedge is commonly used in investments to refer to limiting or eliminating a risk. And a hedge fund is an investment vehicle that has traditionally tried to hedge market risk, which is just the risk of your money being impacted by a larger decline in the markets as a whole. Funny enough, this doesn't actually mean that the fund is safer for its investors. It really just alludes to how hedge funds try to earn a return regardless of what the market as a whole is doing. By itself, this probably doesn't sound all that different from most other investment funds. I mean, who isn't trying to not lose money when markets are down? But unlike a standard mutual fund, traditional hedge funds are organized as limited partnerships that are only made available to accredited or qualified investors. Definitions of accredited investors differ between countries, but according to FINRA, it refers to any individual making more than $200,000 a year or who has a net worth in excess of $1 million, exclusive of their primary residence. In other words, you've got to be rich to invest in them. Nothing like giving the elite more privileges, right? But that's just the beginning, because the hedge fund is actually allowed to do a lot more than your typical mutual fund. Since the hedge fund is only available to accredited investors, it is not subject to the same regulations as standard investment vehicles. Regulators assume that the accredited investor will be sophisticated enough to take on and understand the risks involved with more unconventional investments and assets. As a result, hedge funds are free of certain constraints, disclosure requirements, and oversight bodies that monitor the mutual fund space, allowing these vehicles to essentially invest in whatever the heck they want using whatever strategy they please. That means real estate properties, stock options, swaps, future contracts, physical art, and yeah, even collectibles like Pokemon cards or your grandmother's sewing machine are all technically on the table. Hedge funds also have a lot of flexibility to take on leverage and short positions, something mutual funds are often restricted from participating in given how high risk these types of positions can be. And it doesn't stop there. Whereas most mutual funds are required to be liquid, that is, an investor needs to be able to sell their holding on a relatively quick basis, a hedge fund is actually able to restrict withdrawals and lock investor money in. Now, I get it. Letting a fund restrict withdrawals after losing a bunch of money probably doesn't sound like something that's in the investor's best interest. But, well, yeah, you might be right there. But this does give the hedge fund another advantage over the standard investment vehicle. The truth is, many alternative investments, like we mentioned earlier, including real estate properties and your grandmother's old accessories, are difficult to sell on demand. It can take a few months or even a year to list and sell a residential property. So obviously a fund that needs to convert these types of assets to cash on the daily, i.e. a mutual fund, won't be able to participate. But because a hedge fund can restrict client outflows, they're able to play the long game with these alternative assets without fear that their investors will force a fire sale. Now, this does add a liquidity risk to the investor's portfolio. But if you're a wealthy individual with more money than you know what to do with, this is something you're likely well equipped to manage versus the average Joe who may need to pull their money out of certain positions. So you can see the hedge fund in many ways as like a leveled up mutual fund. And in addition to working with more advanced investments, they also tend to employ more advanced strategies past what you'll likely ever see with a mutual fund. Hedge funds use a combination of stocks, derivatives, and leverage to employ complex tactics for generating excess return and managing risks. A very common strategy, for example, is the long-short approach. This strategy, as the name implies, is when a hedge fund goes long on one position or bets for a position while shorting or betting against another, usually within a related field. For example, if they expected a company like Plain Bagel Co. to outperform its competitor Sesame Sam's, they will buy Plain Bagel Co. shares and short Sesame Sam shares. The idea with this strategy is that it technically eliminates industry risk, or any factor that will move both positions up or down. This means that a factor like a growing demand for bagels will have a moot impact on the fund. The hedge fund will only achieve a return derived from how much Plain Bagel Co. outperforms Sesame Sam's. A market-neutral approach is another similar strategy that instead takes the hedge fund label a bit more seriously, with the fund using similar long and short positions to technically eliminate overall market risk. They try to base their return entirely off of how well or poorly individual companies perform, regardless of what macro factors are at play. There are also arbitrage funds, which essentially look for errors in security prices that they can profit from. This is where you might see traders running more advanced computer algorithms to support their research and trades. And oftentimes, opportunities in this space are exploited in mere seconds, obviously past the capacity of mutual funds and individual investors. A basic example of an arbitrage would be if gold futures were more attractively priced than gold itself. In this case, a hedge fund may go long the future while shorting the metal until the discrepancy is corrected. Lastly, for this video, there's the event-driven strategies, which, as the name suggests, involves entering positions around corporate events, including mergers, restructurings, bankruptcies, so on and so forth. This may sound as simple as buying a company just before it makes a big positive announcement, but again, it usually involves taking on both long and short positions to manage the fund's risk exposure and sort of cherry pick the factors that will impact their return. As you can see, these funds go well beyond the simple buy and hold tactic of most mutual funds. And the list of strategies they employ really does go on. There's certainly too many to cover in one video. But as you might expect, these advanced tactics do come at a cost. Hedge funds are incredibly expensive investment vehicles for the investor. Compared to a mutual fund, which often charges a simple management expense ratio of 0.5 to 3%, most hedge funds charge 2 and 20, which refers to a 2% management fee plus 20% of all profits above a certain threshold known as the hurdle rate. In other words, if the fund outperforms, they get a cut of the profits. This can equate to a lot of money in a good year. It makes the hedge fund a very lucrative investment for institutions to run. It's actually one of the reasons a lot of industry talent ends up working for hedge funds, something that sort of enhances the image of hedge funds being a superior return generating machine. But while hedge funds probably sound like the perfect investment vehicle for beating the market, it's actually been difficult to prove whether they do well for their investors or not. Indeed, there are some hedge funds, like the Medallion Fund, that supposedly have beat the market over time, and by a decent margin. But here's the thing. Because there's not a whole lot of regulation governing how hedge funds operate, they don't actually need to report their earnings publicly. So for now anyways, hedge funds are a sort of black box to us commoners. And outside of when they mess things up for the markets, they'll likely be something most of us never experience further ourselves. But while you may feel like you're missing out on your ticket to the yacht party, I wouldn't get too caught up in the FOMO. Because in truth, most of us are probably best served avoiding the area anyway. Yes, hedge funds may be able to generate above average returns given their larger toolbox, leverage, and expertise. But quite frankly, the added risk really does not make them appropriate for people who can't afford to lose large sums of money. In 2008, for example, many hedge funds actually went under as a result of their risky bets in the housing market and the massive leverage they had taken on to enhance their returns. Obviously, this is a type of loss the average Joe likely wouldn't be able to afford. And again, with liquidity and timing restraints, most of us just aren't well suited to take on that sort of risk, especially if we're relying on our investments for income. I do also want to highlight that while hedge funds have rightfully been the target of much public scorn, in truth, they do have a place in the markets. Don't get me wrong, they have done some shady stuff, and I think we can all agree there definitely needs to be more transparency and accountability in the space. But at least in theory, hedge funds do help keep the markets efficient. Most investment vehicles are adverse to shorting positions, something that in truth helps keep market prices close to their intrinsic value. By exploiting price inefficiencies and betting both for and against companies based on their value, hedge funds help with both price discovery and market liquidity, something that a lot of research suggests makes trading cheaper and a lot more efficient for the rest of us. That being said, there are of course issues. With such a lax system, it's easy for greedy individuals to take on excessive risk and endanger the rest of our financial well-being, largely without consequence. In 2008, for example, many financial institutions were bailed out of bankruptcy, despite their suffering being largely self-inflicted. While this did help prevent a collapse of our financial system, the fact that we were in a position where this could happen in the first place is clearly a problem. So next time you hear about a hedge fund, hopefully you'll better understand how they operate and why they're probably in the news for a bad reason. Fortunately, there has been a renewed call for action in the space. So while we may not see any action on the regulatory side of things for quite some time, at the very least, people seem to be more aware and more willing to put their own money at risk to keep the deviant players in line. This video is sponsored by Morning Brew. I read the news every day to keep a pulse on the markets, but reading through dry articles and headlines about economic figures can admittedly be a grueling task at times, especially first thing in the morning when you haven't had much sleep. But I've enjoyed reading Morning Brew to catch up on the daily happenings, and I recommend you check them out. Morning Brew is a daily newsletter that gets you up to speed on business, finance, and tech in just 5 minutes. And compared to traditional newsletters, the information is presented in a witty and oftentimes humorous way, making it a great choice for easing into your day. You'll always hear about important earning releases and headlines, but there are also some interesting facts tossed in there as well. On last Saturday's edition, for example, I learned that 2.7 million Americans are planning to retire earlier than planned as a result of saving during the pandemic. It's an awesome source of news, and the best part is it's completely free. Just use the link in the description below to start receiving your daily dose of the brew. So if you've been looking for a more entertaining source of your daily happenings, I highly recommend you check out Morning Brew.